Hello and welcome back to the American Dream Portfolio. In this final video of a 4-part series on how emotions can increase investment risk, we take a close look at greed, which is a set of behavioral traits driven by emotion and reckless reasoning. If we are to believe the mainstream media, virtually all of Wall Street as well as a large percentage of traders, and even serious investors, are driven primarily by greed. What do we mean by greed? For our purposes, greed is a strong and unreasonable desire to profit from an investment out of all proportion to what is at stake. In other words, one is driven by an almost lustful quest for easy money. While an investor may hope for, and even dream of, his portfolio reaching $1 million before his 50th birthday, that is not greed if he is now 35. Reaching his goal may require patience and discipline for the next 15 years, and that is something the person of greed does not possess. But if he turns 50 in just 2 years, and his portfolio balance sits at $350,000, his commitment may lure him into greed-driven behavior. Just how might that behavior reveal itself? Because greed, like fear, is at the extreme end of the behavioral spectrum, its underlying drivers can be unexpected. We see greed as being emotionally driven by one of two opposing cognitive forces. The first is superficial and sometimes cruel calculation. The second can best be described as blind disregard of reality, even among those with a strong intellect. Let's look at an example of each type of greed, keeping in mind that greed may represent a risk by causing the investor to sell at a loss. At first glance, and again referring to the diatribes of the mainstream media, greed should be easy to spot in the investment world. But in its truest form, greed is almost rare to find. While it is true that there have been many greed-infested shenanigans to come out of Wall Street, from Ponzi schemes to abuse of obscure concoctions like credit default swaps, these are the actions of highly placed executives and other institutional players, rather than those of individual investors who are the focus of this channel. So the question is, how might the individual investor, absent those actions which could be considered thievery or outright fraud, exhibit greed? Well, a few minutes ago we profiled an investor, aged 48, who is bent on nearly tripling the value of his portfolio by age 50. That would require exceptional investment acumen and luck, or, instead, maybe just a little dose of greed would do the trick. When the curtain rises, it's April 2022, and the stock market has been trending down since January on fears of ongoing inflation tied to the COVID-19 pandemic. Our man of greed coolly assesses the situation and sees an open door to some serious and easy cash. And what's the mechanism for the bumper crop he has in mind? In a word, it's leverage. Using other people's money to make yourself rich. As individual investors, we may access other people's money through a margin account, which is borrowing money from your broker to purchase investments. Our subject knows enough about investing to realize that stocks tend to go down a lot faster than they go up. He knows, for example, that while the COVID crash took only 5 weeks from peak to trough, its recovery took 5 months. And that was considered one of the quickest recoveries on record. Looking at the charts, he sees that the S&P 500 is down over 5% from its January high, and likely to lose much more. He could make money shorting the S&P, but he wants to play for bigger stakes. A few of his buddies made big money last year on a high-flying tech stock called Nvidia, but now the stock is crumbling. Down over 20% since January. And his pals are selling for modest gains. The stage is set for our man of greed to make a killing. He reasons that if the prospects for the overall market are poor over the next several months, the prospects for a tech superstar like Nvidia are worse. He is probably right, but how to profit from this insight? Simple. Open a margin account with his broker and short Nvidia stock to the max. Checking with his broker, he learns that he can borrow up to 70% of his short position, while he contributes just 30%. And just what is a short position? It's an investment that wins if the underlying asset goes down in price. Here's how it played out with Mr. Greed. Of his $350,000 account, he decided to leave $100,000 in cash and use the remaining $250,000 to stick it to Nvidia and his know-it-all friends. Using his margin account, he placed an $833,000 short sale on Nvidia on April 15th, tax day, when Nvidia was selling at $22 per share. This transaction meant that Mr. Greed sold over 37,000 shares of a stock he never owned. On the strength of his margin account, his broker lent him the shares so that he could sell them immediately, while prices were presumed high. But to pocket his winnings, he would have to repurchase those 37,000 shares and return them to his broker at some future date, when he expected prices to be much lower. So the idea is to sell first when prices seem inflated, then buy back later when prices are depressed. This allows you to pocket the difference. So what happened? Over the next several months, Mr. Greed was giddy with delight. By mid-October, Nvidia stock had fallen to just over $11 per share. That meant he could have replaced the shares his broker lent him for only $435,000. Doing so would have resulted in the following profit. Original proceeds of $833,000 minus cost of $435,000 meant Mr. G would get his original investment of $250,000 back plus an additional $148,000. That represents a 60% profit in just 6 months. Fancy making $148,000 in 6 months just for being clever. But Mr. G didn't buy back the shares in October. He was greedy and he wanted more. He expected the share price to continue falling, which would have further inflated his profit. Instead, he watched the share price climb through a series of what he called bear market rallies, convinced the stock would ultimately tank. But it didn't. So, on tax day 2023, with his broker pressuring him for those 37,000 shares, Mr. Greed bought them back at a market price of $27 per share to close the trade. How bad was the carnage? Well, buying back those shares cost $1 million. The original $833,000 in proceeds left a shortfall of $167,000, which came out of Mr. G's hide. Also coming out of his hide was his original $250,000 investment, and that doesn't include the 6% interest rate his broker charged on the borrowed money. This greedy little escapade meant that Mr. G was now well and truly wiped out. Okay, how else can greed play out for the individual investor? Well, if Mr. G's is an example of lusty miscalculation, what about greed resulting from a blind disregard of reality? This one can be explained much more easily. The most common example of mindless greed is the substantial investment which is made based on nothing more than a casual tip. This tip might come from a friend, a family member, a talking head, or from a conversation you overheard at a restaurant. Investing on a tip represents greed rather than stupidity because the expectation is that very valuable information came to you at no cost. While others may spend months and even years building investment data and experience, you had it handed to you on a silver platter and you were shrewd enough to recognize it. Examples include the podcast guru who urged that now is the time to load up on crypto, or the favorite uncle who guarantees that the latest initial public offering will pay for your retirement. Let's not forget the neighbour you see regularly at Pilates who swears by an investment in Lululemon, and of course the finance professor who casually mentions that you can make a killing trading pork belly futures. Good luck with all that. Okay, we have spent the last 4 videos looking at emotionally driven behaviour and how emotions can be risky business for the investor. In our next video, we begin looking at how to keep our emotions and our risks in check by carefully devising an investment plan. See you then.